How to spot costly loan estimate mistakes, Part 1. You know, a lot of people buy a home without really knowing what they're actually paying for. Today, I want to break down one of the most important documents, the loan estimate. Understand it well, and you'll save yourself a lot of money when applying for a mortgage. Why the loan estimate matters. The loan estimate shows you almost every cost related to your mortgage. And by law, once it's issued, most of those numbers cannot just be changed by your lender or loan officer. Only minor adjustments are allowed, so if you understand it properly, you won't feel disappointed or shocked later when it's time to close. Key indicators you'll find in the loan estimate. The loan estimate is 3 pages long. Today, we're starting with page 1, the foundation. Later on, you'll get a closing disclosure before signing, but the loan estimate is your first true roadmap. It shows you the big picture early, and that's the key to avoiding surprises. Once you get to the closing disclosure, the numbers are final. When you get your loan estimate, the fees listed can still adjust slightly during the loan process. Some things can move a little, so the loan estimate is your early warning system. Basic information check. First, look at the date issued. It should be within 3 business days after you submitted your full application. If not, something's wrong. Next, double-check your name. It must match exactly what's on your ID, middle names included. Trust me, you don't want mismatched names to delay your closing. Also, check your mailing address. It may not be the property address you're buying. Make sure important documents get sent to the right place. And always double-check the sale price. It must match your final signed purchase contract, not an earlier offer. Core terms of your loan. Check the loan term first. Is it 30, 20, or 15 years? Longer terms mean lower monthly payments but more total interest. Shorter terms cost more each month, but you save a ton on interest overall. Then check your purpose. Are you buying or refinancing? It makes a difference. Look at the product. Is it a fixed rate or an adjustable rate mortgage? Fixed rate stays the same. Adjustable could change later. And finally, the loan type, conventional, FHA, or VA. Each one comes with its own rules and benefits. And don't forget your loan ID number, you'll use it throughout your application. Interest rate and rate lock, is it secured? This part is huge. Is your interest rate locked? If not, it could change daily, even hourly due to the market. Once you lock it, it's frozen, but only for a set period. If your closing gets delayed, you'll have to pay a fee to extend that lock. And no, unfortunately you can't just relock a new rate instead of the old rate if it expires. So if you like your rate, lock it fast, and get your paperwork done before it expires. Loan amount and interest rate, are they correct? Now, check your loan amount carefully. It should match your expectations after the down payment is deducted. Next, check the interest rate listed. If it's locked, great. If not, keep an eye on it because it can change, sometimes even within the same day. A tiny rate change could cost or save you thousands over the life of the mortgage, so don't skim this part. Monthly principal and interest, your true base payment. Here's the number you'll pay every month, but wait, it's only for principal and interest. It doesn't include property taxes, homeowner's insurance, or any association fees. Your actual monthly payment will almost always be higher than this base number. Be sure you plan for the full cost, not just the minimum listed here. Mistakes you must avoid reading the loan estimate. Prepayment penalty, will paying early cost you? This one surprises a lot of people. Some mortgages come with a penalty if you pay them off early, either by refinancing or selling the home too soon. Check your loan estimate for the line that says prepayment penalty. If it says yes, find out the details. You might have to pay thousands just to get out of your mortgage earlier. Usually, this penalty only applies during the first few years, like the first 3 to 5 years. But still, you need to know about it up front. If you're using an easy document loan, or a non-qualified mortgage loan where the lender doesn't fully verify your income or assets, these often come with stricter terms, and a prepayment penalty is one of them. If your loan estimate says no, you're safe. You can pay off early anytime without a fee. Always check this section carefully before you sign anything. Balloon payment, a big surprise you don't want. Balloon payments are rare these days, but they still exist. A balloon payment means that after years of paying smaller amounts, you suddenly owe one big lump sum at the end of the loan. Most regular fixed-rate mortgages do not have a balloon. But if you see one listed on your loan estimate, be careful. You'll need to have a plan to handle that giant payment, or refinance before it hits. Projected payment, the real picture. This section breaks down everything you might pay every month. You'll see the base principal and interest, but also added costs like mortgage insurance if your down payment is small, property taxes, homeowner's insurance. And finally, if your home is part of a planned community, condo complex, or subdivision, you might have HOA fees, or Mello-Roos. That's short for homeowners association fees. They cover shared amenities like pools, parks, private roads, or building maintenance. Some HOA fees can be as low as $20 a month, but others could be several $100s, especially in bigger cities or nicer communities. All of these pieces together make up your true monthly mortgage cost. A lot of first-time buyers make the mistake of only budgeting for the principal and interest. Then reality hits when all the other costs pile up. Use this section to build a complete, realistic monthly budget for your homeownership. Closing costs and cash to close, what you really need. This is where the math gets real. Closing costs are the combination of lender fees, third-party fees, title fees, and taxes you have to pay at closing. Cash to close is the total money you need to bring when you sign, after applying any credits like earnest money or seller assistance. Sometimes, people are shocked by how much they need at closing. Especially if they didn't carefully check their estimate early on. Plan for it. Know it in advance. Because nothing's worse than scrambling to find extra cash on closing day. The loan estimate isn't just a boring form. It's your shield against nasty financial surprises. Read it carefully. Ask smart questions. And if you need help making sense of it, reach out to us. We'll make sure you walk into your closing day fully confident and prepared. We're going to break down page 2, where you find a detailed breakdown of your closing costs and exactly what fees you should expect when you get a mortgage. Stay tuned for the video, How to Spot Costly Loan Estimate Mistakes, Part 2.
Real estate and mortgage broker Danguard, with experience in over 1,000 loan applications and real estate transactions, aims to provide you with useful and general knowledge about this field. For advice on each specific case, please contact via email or website provided below the video. Don't forget to click like and subscribe to the channel to stay updated with the latest information from Danguard.